If you're an average Aussie working hard, paying your bills, and trying to get ahead, the 2026 federal budget was supposed to be good news. Jim Chalmers stood up in Parliament with a smile, talked about tax cuts, cheaper medicines, and a fair go for first home buyers. And on the surface, it sounds great. A $268 tax cut here, a $250 offset there, fuel excise temporarily slashed. But here's the truth nobody on the nightly news is telling you. Behind the headlines, this budget does something else entirely. It crushes the average Australian in 5 ways most people will never see coming until it's already hit their bank account. So if you earn a wage, own a home, invest in shares, or just buy groceries in this country, you need to hear this. Because by the end of this video, you'll understand exactly what's being taken from you, why it's happening, and what you can actually do about it. Number 1, the tax cut that isn't really a tax cut. Chalmers proudly announced a $250 working Australians tax offset starting from 2027 to 2028. Sounds nice, right? Here's what he didn't tell you. The Australian Financial Review crunched the numbers and found that bracket creep, which is when inflation pushes your wage into higher tax brackets, will swallow that entire offset within 2 years for most workers. If you earn $79,000, you get $268 back. But the extra tax you'll pay from wage growth pushing you into higher brackets is far more than that. So you feel like you got a tax cut, but in reality, you're paying more tax than you were before. It's a magic trick. The government hands you a $250 note with one hand while pulling $500 out of your pocket with the other. Bracket creep is the most insidious tax in the country because it raises your tax bill every single year without a single politician having to vote for it. Think about that for a second. Every other tax has to be debated, voted on, and announced publicly. Bracket creep just happens in the background while your wage technically goes up. That's why even economists from both sides of politics call it the lazy way to raise revenue. It punishes the people who get pay rises, work overtime, or pick up a second job. The harder you work in this country, the more they take, and you never get a vote on it. Number 2, the capital gains tax change that hits the average investor. The headline reform sounds fair. Replace the 50% capital gains tax discount with one based on inflation and bring in a 30% minimum tax on gains for properties and shares sold after July 2027. Chalmers framed this as targeting wealthy investors. But here's the reality. The average Aussie with one investment property, or anyone holding shares in their own name to build retirement income, gets caught in this net too. If you bought an investment property 10 years ago and you sell it after July 2027, the tax you pay could be tens of thousands higher than under the old rules. The same goes for shares you've held outside super. And this is the kicker. Inflation was the very thing the government created with massive spending. Now they're saying they'll only let you discount your gains by inflation. So they cause the inflation, then they tax you for trying to outrun it. Number 3, the $1 trillion debt nobody wants to talk about. Gross government debt is set to cross $1 trillion in 2026 to 2027 and peak even higher than last year's forecast. The interest payments alone on that debt are now one of the fastest growing line items in the entire federal budget. Every dollar spent paying interest is a dollar that isn't going to your hospitals, your roads, or tax relief for working people. And who pays this back? You do. Your kids do. Through higher taxes, weaker services, and a dollar that buys less every single year. The Reserve Bank has been screaming at the government to rein in spending because too much government spending fuels inflation, which keeps interest rates higher for longer. That means higher mortgage repayments for you, so the more they spend, the more your mortgage costs. It's a direct line from Canberra's spending habits to your monthly bank statement. Think about that the next time your mortgage gets reviewed. The extra hundreds you're paying each month aren't just bad luck. They're the cost of decisions made in Parliament that you had no say in. Number 4, the hits to older Australians and anyone with private health cover. This one barely made the news. Australians aged 65 to 69 earning under $101,000 and $1,000 as a single or $202,000 as a family will see their private health insurance rebate cut from 28% down to 24%. That means higher premiums for the exact people who use private health the most. On top of that, changes to the Medicare levy will cost Australians over 65 an extra $240 a year. If your parents or grandparents are in this group, they just got hit with a few $100s in extra costs they weren't expecting and weren't warned about. And for everyone else, the government also wound back parts of its aged care reforms, meaning families will end up shouldering more of the cost of looking after older relatives. Number 5. The defence and infrastructure spending boom that locks in higher taxes for a decade. Labor has committed an extra $53 billion on defence over the next 10 years. They're also pouring nearly $4 billion more into Melbourne's suburban rail loop, a project that's already been criticised for cost blowouts. Add billions more for fuel security, housing infrastructure, and a long list of other commitments. Now look, defence spending might be necessary. Infrastructure might create jobs. But here's the part Chalmers didn't say out loud. None of this is being paid for by genuine savings. The so-called $64 billion in savings is mostly money being shuffled from one program to another, not actually banked. Which means the only way to pay for all of this in the long run is more debt, more inflation, and more tax. And bracket creep is the perfect weapon for that. You won't see a new tax announced. You'll just notice that every year you keep less of your pay. That's the plan. It's already in motion, and nobody at the press conference is going to spell it out for you. So what does all of this mean for you, the average hard-working Australian? It means you can't rely on the government to make you wealthier. You can't wait for tax cuts that get eaten by bracket creep before they even arrive. You can't depend on a budget that raises the cost of investing, owning property, and growing older in this country. The truth is, the rules of money in Australia are shifting faster than most people realise. What worked for your parents, buy a house, work one job, retire comfortably, no longer works the same way. Wages are taxed harder, assets are taxed more, inflation eats your savings while you sleep. And the gap between the people who understand the system and the people who don't is growing wider every year. The only person who is going to protect your financial future is you. That starts with 3 simple steps. First, get crystal clear on where your money is actually going each month. Because most Aussies have no idea, and that's exactly how budgets like this catch them off guard. Second, start building income streams outside of just your wage, because wages get taxed the hardest and inflated the fastest. Third, learn the rules of the game before they change again, because they will change again. The Australians who come out ahead over the next decade won't be the ones waiting for Canberra to save them. They'll be the ones who understood the rules, adapted early, and took control of their own money. If this video opened your eyes, do me a favour. Hit the like button, subscribe to the channel, and turn on the bell so you don't miss the next breakdown. Thanks for watching, and I'll see you in the next one.